Hey, what's up, my friends? So, welcome to the Ultimate Price Action Trading course for beginners. And in this course, you will learn number one, 5 myths about price action trading that nobody tells you. So, for example, one of the biggest myths that I've come across is someone saying, price action trading is all about support and resistance. Now, if you believe that myth, right, then you will be blindsided to the other professional tools that price action traders use to get results. So, I'll share with you what are these 5 myths about price action trading and how you can actually avoid them and not make common mistakes that other traders will make. Next thing, you'll learn a professional price action trading strategy that works, and you can apply this across different markets or time frames. And the best part, you don't have to rely on indicators, news, or signal services. Then you also know, right, or learn how to know when exactly to enter a trade and when to stay out of the markets so you can avoid unnecessary losses. And throughout this entire course, I'll share with you a ton of charts and examples so you can quickly understand the trading strategies and concepts. So now the question is this training for you? So who is this for? This is for you if you're a beginner trader and you want to learn more about price action trading. This is for you if you want to trade successfully using naked charts without indicators. And this is also for you if you're an experienced trader who wants to learn advanced price action trading strategies and techniques, right, to improve your trading results. If any of this sounds like you, then today's course is for you. So now, before we talk about what exactly is price action trading, let's debunk, right, some of the most common price action trading myths. Number one, price action trading is support and resistance. So I've seen this a number of times. Rayner, support and resistance, isn't it price action trading? So let's be clear over here. So I would say support and resistance, it's a component in price action trading, but it's not price action trading itself. It's like saying, a car and an engine, they are the same. No, an engine is a component of a car. A car has many components. You have the engine, the gearbox, the tire, the steering wheel, the handbrakes, and stuff like that. So support and resistance is a component of price action trading. They are not on equal footing. Okay, that's what I would say for now. Next one, price action trading is candlestick patterns. Again, candlestick patterns, it's a component of price action trading, but not price action trading itself. I'll explain more on this later on, but just want to kind of debunk some of these myths that's going on. Right? Price action trading is naked trading. So I get it, right? As a price action trader, you technically don't need indicators in your trading, but that's not to say that you can't use indicators in your trading, because as I've said earlier, once you become more proficient in trading and you understand the indicators, how they work, you can actually supplement indicators in your own trading, in your own price action analysis. Because what's going to happen is that indicators will kind of make your life easier. It helps you, summarize past prices on the chart and gives you a certain value that you can use it to make your trading decision. For example, one example I gave you earlier was, trailing your stop loss using a moving average. Another example I can share is, you can use the average true range indicator to help you set a proper stop loss so you don't get, stopped out too early. I'll share that more with you later, but again, I want you to know that price action trading, right, in a way, it's naked trading on a chart where, you try to keep it as clean as possible, but it doesn't mean that you are banned from using indicators. No, you can have the best of both worlds. You can apply price action trading methodology, supplement it with indicators, right, to make your life easier. It only works on a higher time frame. This is a good one. Rayner, price action trading only works on the daily time frame, right? It doesn't work. So let's do a very simple exercise right now. I'm going to share with you 2 charts. Okay, and I want you to tell me which chart is on the daily time frame and which chart is on the 5 minutes time frame. Sounds good? So just have a look at this chart. Okay, so I'm going to move on to the second chart. Okay, so is this a daily time frame or 5 minutes time frame? I'm going to share the answer with you, right? And some of you have just said, right, you can't tell. And that's my point. You can't tell whether a chart is from a daily time frame or a 5 minutes time frame, because price action is price action is price action. And in case you're wondering, I'll be honest with you, both of these charts are actually on the daily time frame. Both example 1 and example 2 are on the daily time frame. There's no 5 minutes time frame here. And again, the point is just to show you that when you look at a chart, okay, price action trading, as long as there's sufficient liquidity in the markets, as long as a chart looks like a chart, price action trading methodology can be applied to it. Hope that makes sense. Okay, so again, this is a myth, right? It doesn't mean that price action only works on the daily or weekly time frame, or it's more accurate on the weekly time frame. No, none of that. And finally, the last myth is that price action trading can only be applied to the Forex market, because I think that's where it gained its popularity from the Forex market. But here's the thing, right? Price action trading, in essence, what you're trying to do is to identify imbalance of buying and selling pressure in the market and then use it to, time your entry, to enter a trade. So imbalance of buying and selling pressure in the market is due to greed and fear in the market. So if you say that price action trading can only be applied to the forex market, then you're in essence saying that there's no fear or greed in the crypto markets, there's no fear or greed in the stock markets and stuff like that, which again doesn't quite make sense. So a lot of times, right, you can see that when I come up with I wouldn't say a theory, but my own beliefs of the market, I use this type of questions, right, to question myself, to question what out there, to come out and answer, right, that I am satisfied with. And again, I could be wrong because I'm always learning. I'm always a student of the markets. And sometimes my beliefs are challenged. I like to go back and think deeper about it, especially if it's things that I can't quantitatively do a back test on it. I like to, use these thoughts, these beliefs, right, question myself and to assess, right, whether what is right or wrong. So again, I want you to do the same. Don't just take what I say at face value. It's something that I've preached over so many of my videos. Take the stuff that I've teach you, test it out, verify it for yourself and see whether it works or not. Okay, so this is what I do for myself. I always question what I know using new additional input or information that I come across. So with that said, okay, let's move on and talk about what exactly is price action trading, since we have talked about it's not support resistance, exactly, it's not candlestick pattern. So in my own humble opinion, right, this is the definition of price action trading, at least for me. Price action trading is a methodology that helps you identify the current market conditions so you can adapt the right trading strategy at the right time. Okay, so in essence, if I see a market that is trending higher in an uptrend, I want to be a buyer. I want to look for buying opportunities. Or if I see a market in a downtrend, then I want to be a seller. I want to look for selling opportunities. So this is what I mean by, identify the current market condition so I can adapt the right trading strategy at the right time. So I know what to do at the particular point in time. So that's what price action trading is about. Also, another thing to note is that price action trading, there are many forms of trading out there. There's, what we call the discretionary trading approach and quantitative trading approach. So discretionary trading approach is where price action trading lies because there's this element of discretion over here. For example, when you draw support resistance, there's this element of discretion. Do I draw at this level or do I draw slightly lower? Or maybe when you identify, let's say, an uptrend, a series of higher highs and higher lows, do I take into account that swing low or not? So there is this element of discretion. As much as possible that we want to be objective in our trading. When it comes to discretionary trading, like price action trading, there are times, right, where you have to make a discretionary decision that could differ from another trader. So this is what we mean by discretionary trading. And price action trading happen to fall in this camp. So how do we apply price action trading in the markets? So if you look at the definition I had for you earlier, it's a trading methodology that helps you identify the current market condition so you can adapt the right trading strategy at the right time. So how do we define current market conditions? So the first thing as a price action trader is that we want to ask ourselves, what is the current market structure? In other words, you're asking yourself, right, what should I be doing? Do I buy? Do I sell? Or do I stay out of the markets? That's the first question. Because if you can't answer this question, then really, you can't, do anything else without, answering this question first. So to answer this question, right, I'm going to share with you 3 general framework that you can use. There is more to it, of course, but, since this is like, only a 12-hour presentation, there's only so much depth I can go. So in terms of market structure, you can talk about uptrend, downtrend, or range. So let me just draw an example. Let's see if I can give a tool and hopefully you guys can see. So, okay, let's talk about uptrend. So uptrend is pretty straightforward. Market makes a series of higher highs and higher lows. Okay, like this. So at this point, you can see I'm drawing a series of higher highs, higher highs, higher highs, higher highs, and higher lows, higher lows, higher lows, higher lows, higher lows. And one thing to point out is that if you have, studied charts enough, you know that this market structure works in textbook, but in the reality of trading, what can happen is that market makes a deeper pullback like this and then continue higher. So at this point, right, do we consider this, like a breakdown or is this just a pullback? So on the hindsight, you can see, oh yeah, the uptrend is still intact. So what I want to point out is that this concept, this framework that I'm sharing with you, it's kind of like simplified. In the real world of trading, things might be different. And I want to prepare you for it. A downtrend market is just the opposite, a series of lower highs and lower low. You can see, right, lower high, lower high, lower high, and lower low, lower low. Range market, what about that? Okay, so range market is also pretty straightforward. You have this highs and this lows. So the price goes up, comes down, goes up, comes down, goes up, comes down. So you can see that when I do this range, I try to make it similar to how you would see in the chart. I draw a line over here, but when you have your support resistance, your swing high, swing lows on the chart, you won't expect it to respect the line to the dot. You might exit above it and come back down, then exit, go up, go down, exit it by a certain margin. So again, this is really what's going to happen in the real world of trading. Okay, so that's pretty much what we're trying to do over here to define the market structure. So let me share with you some chart examples so you can actually see what I mean. Okay, let's go. So let's have a look at this chart. You can see this one is New Zealand yen, and what is this? Uptrend, downtrend, or range? I think it's quite a intuitive, right? And most of you are going to say it's an uptrend, so I'm not going to waste your time. So New Zealand yen, in this case, clearly it's in an uptrend, and since this market is in an uptrend, we want to look for buying opportunities. Where do we buy? When do we buy? Let's leave that out for now. We'll talk about that later. Next one, dollar against the Chinese yuan. Look at this, a series of lower highs and lower lows. So do you need me to draw for you? I'll just do this for this one, right? Lower highs, lower highs. And you can see this lower high, it actually took out above this previous swing high and then continue lower. Right? So you can see that, in the real world of trading, it's not going to be as pretty as what the textbook or as simple as what the textbook has shared. It might have some, price exceeding a certain levels to kind of fake you out, to bluff you, and then, continue back in the original direction. But the general rule is this, or rather, when you look from left to right, I'm sure you can agree that this market, the dollar against the Chinese yuan, is in the downtrend. Okay, and finally, one last one, pound Canadian. What about this one? I think the weekly time frame is a good illustration. I just zoom out a little bit. You can see that this market, I would say it's in a range, right? It's contained between these highs, and this lows over here, right? So this market is in a range. Okay, so that's pretty much what I want to talk about market structure. So moving back to the slides, number 2, area of value. So where do you buy and where do you sell? So what is area of value? So area of value simply refers to a area on your chart where potential buying or selling pressure could step in. So for example, let's say area of value at support, right? It's a potential area on your chart where it's an area on your chart where buying pressure could possibly come in and push the price higher. So area of value, in essence, right, what it's telling you is that, where should you buy? So you know that market structure tells you what to do. Should you be buying? Should you be selling? Or should you, trade the range? Okay, so let's say, for example, market is in uptrend. You should be looking for buying opportunities, but it doesn't mean that you want to blindly hit the buy button. No, you want to trade from an area of value, an area where you can define your risk. All right, so the area of value tells you where to buy. Market structure tells you what to do. Area of value tells you where to buy. So where do you buy? Well, you can buy it from an area of value like support and resistance, moving average, trend line, channels, etc. And if you ask me, my favorite is support, moving average, and trend line. I would say trend line not so much because you don't get as many trend lines compared to support and moving average. So my favorite, or rather the trading setups that I find myself taking often, is trading from an area of value like support and moving average. Okay, so those are area of value that I would say it's worth learning. So let me just draw for you some examples before we look at the charts. So for example, area of value like support in an uptrend would be something like this. Okay, this is an uptrend and price to retest this area of support, right, in this existing uptrend. Okay, so that's one support. For moving average, it will look something like this. Okay, let's say market is in an uptrend, series of higher highs and higher lows. And what happens is that this particular moving average seems to be, rather the pullback seems to be respecting the moving average here, here, and here, right? So you will test it a number of times. And this is usually quite apparent when it's in a healthy trend, retesting the 50-period moving average. And finally, the last one would be a trend line, which is something like moving average. The only difference is that the trend line is straight instead of, curvy. So let's say market in uptrend. Okay, then you have this trend line that it's a very straight line that connects the pullback, right? So there's another area of value here, here, and here. So as mentioned, right, I would say support and moving average are kind of the ones that I use very often in my trading. So let's have a look, shall we? Okay, so let's have a look at some real world examples of how these charts look like. Brent crude oil. If you look at this over here, we have a number of support, right, acting as area of value of this chart, right? This is an area of value support in an uptrend. There's possibly another one over here. Okay, so you can see that for this chart, this time frame, Brent crude oil, the 8-hour time frame, we have a number of area of value here, which is actually support, right? Support and support. Okay, so that's one way to define it. Another one, let me share with you another example. This time around, let's have a look at 50-period moving average. Okay, so dollar against the Chinese yuan, the 8-hour time frame. As I mentioned, right, the 50-period moving average can also act as an area of value. So in this case, see, tested number of times here, tested once, twice, right? So this one, actually, this is, I would say this twice and this twice. So you can see that the third time it tests, right, it's not exactly to the line. It could exceed the moving average by a little bit and then come back down lower, just like in this case as well. Exceed a little bit and then come back down lower. So that's why I call it area of value, not line of value. It's an area on your chart. Okay, so that's and finally, one last thing to share with you. It's okay, so this is what we call the trend line flip. So you can see the Euro Aussie. I'm just going to zoom out the charts. It was respecting this trend line here, tested once, twice, 3 times. Then it broke below it and then retested like a kind of like a backflip. So it's kind of similar to the previous support become resistance, that concept. So this one is, but instead of, horizontal line like support resistance, this one is in the form of a trend line. So this is another way that you can define your area of value on the chart. So this one needs some practice, right? But the key thing is to share with you to open your eyes to the different ways you can, define your area of value. Okay, I hope that makes sense. And moving on, let's move on into the next thing, the next concept, which is what I call entry trigger. So here's what we have covered. We have talked about market structure. What should you do? Should you buy, sell, or stay off the markets? Next thing we spoke about is the area of value. Where do you buy? Where do you sell? And now the third thing, entry trigger. This simply means, right, when exactly are you going to enter a trade? When? At what specific moment? So in essence, it's answering the question, when to buy or sell? When? Today, tomorrow, now, 5 minutes later? When? When exactly? So to do this, right, I would say the topic, or rather the topic on candlestick patterns is really useful, because candlestick patterns, in my opinion, is useful to serve as an entry trigger to tell you when exactly to enter a trade. Now, don't get me wrong. I'm not saying that just because a certain candlestick pattern has formed, it means buy. No, we must take it in the context of the market. We must first and foremost understand what is the market structure, whether it's from an area of value, and then, and only and then, we look at the candlestick pattern to help us act as an entry trigger. Make sense? Okay. So let's have a look. I'm just going to run you through simple stuff, nothing too complex. First one, hammer. So why am I sharing hammer? And as you know, right, next one is going to be a bullish engulfing pattern. And that's the reason is because it's these two reversal candlestick patterns, in my opinion, it happens with regularity. So whenever you are trading the markets, right, there's a good chance that it could be a hammer or bullish engulfing pattern, and it's worth learning. Okay, so let me just walk you through how this works. So hammer, in essence, right, the candle, if we look at the daily time frame, it means that for today, the price opened here. This is the opening price. If this is a daily candle, right, this is the opening price at the low. And then it closed at the high of the day. So what happens is that when the market opened, the sellers were actually in control, right, for a certain portion of the day, right, pushing the price near this lows over here. Then the buyers came in, I'm back, baby. Then they pushed the price all the way up higher and finally closing near the highs of the day. So you can see that it's kind of like a battle between the buyers and sellers. Price open, sellers come in, push the price down low. Then after that, the sellers, they kind of hold their fort. That's enough, right? And then you have their full forces coming, the rest of the army coming and push the price all the way up back and close near the highs of the day. So this is what we call a hammer, because it looks like a hammer, right? And it's a bullish signal, right? Telling you that the buyers, right, they are now in control of the markets for this temporarily for now. Okay, so this is the hammer. Next one here, it's the bullish engulfing pattern. Okay, so which looks like this. So this one, again, if you look at the concept behind it, it's actually quite similar to the hammer. So just to walk you through over here, you can see that on this, let's say on a daily time frame, the previous day the price has closed bearishly lower for the day. The next day, what happened is that the market opened here, and then almost immediately the buyers come in and ramp up the price all the way up higher and closing near the highs of the day. Okay, so again, this is a bullish engulfing pattern. It tells you that for today, when the market opened, the buyers were in control from start to finish, and they managed to hold up and close higher for the day, telling you that hey, we just won that battle. Okay, so temporarily the buyers are now in control. Okay, so this is what we mean by bullish patterns, hammer and the bullish engulfing pattern. So earlier we were talking about the bullish patterns, and then the next thing that I want you to know is the bearish patterns, because you can't just know bullish patterns, because if the market is in a downtrend, right, you want to look for selling opportunities, then you want to be familiar with, bearish reversal candlestick pattern. So the first one is hammer. So this is kind of like the inverse. Oh, this is wrong. This should be shooting star. Should I edit here? Nah. Okay, so let's go. Right, shooting star. Ding. So what this means, right? Let me just walk you through the buyer and seller psychology of this market. So market opened at this price over here, okay, and the buyers came in and took control and pushed the price all the way up higher. So you can see that during this day, the price was actually trading near these highs for the day. And then somehow or other, maybe it could be a bad news, maybe it could be a bad event, could be, bearish sentiment. The seller just came in and stomped all the way down and pushed the price lower for the day. Or maybe they took too much steroids. I do not know. Okay, so you can see over here, this is a shooting star. This tells you that buyers, for a certain portion of the day, they were actually in control. The price was actually heading higher. But after which the seller just came in and just rammed the price down and closed lower for the day. So this tells you that momentarily, right, the sellers, they are in control because they have actually managed to close the price lower for the day. So the next pattern is this one here, bearish engulfing pattern. So again, similar to the bullish engulfing pattern, but just the inverse. So to walk you through it, you can see that previous day, market is closed bullishly near the highs. The next day, the sellers came in, opened here, and then they just smashed the price down lower and closed lower for the day. So this is what you have, a bearish engulfing pattern. And one thing to point out, right? If you trade Forex, if you trade stocks, you realize that these technical definitions, it is a bit different. Because for the Forex market, okay, let's talk about the stock markets. The way people define engulfing pattern is that the candle has to engulf the entire previous candle. So this means that it has to sort of like, gap up higher and then close lower and kind of like, cover the entire of the previous candle. But the reason why you shouldn't expect this for Forex is because the Forex market, it seldom gaps. It runs almost 24/5 a week. So you hardly see gaps on the chart, unlike a stock chart pattern. So when you trade the engulfing pattern, please bear this in mind. You won't expect to see much gaps in the FX markets. But when you trade stocks, right, gaps are going to be more apparent. So my technical definition of the engulfing pattern, right, the bearish engulfing or the bullish engulfing, is that the body of the candle has to cover the candle of the previous body, the body of the previous candle. So in other words, okay, let me just re-explain that. My definition of engulfing pattern is this, is that the engulfing pattern, right, the range of the candle has to cover at least the body of the previous candle. As long as it covers the body, that's fine. If it doesn't cover the wick, it doesn't cover the highs and lows, that's perfectly fine by me as well. All right, so here is really, I would say the context is what matters here. Right, the main thing you want to see is that, either the buyers or sellers in control and quickly, push price away from a certain level. The speed of the price moving away from the level, that's the key over here. Not, whether it covers half body, naked, or whatsoever. That's really, getting away, missing the forest for the trees. Okay. So another thing that I also want to point out is that when you deal with when you deal with candlestick patterns, there are a lot out there. Right? I'm sure, most of you have studied, things like shooting star, hammer, harami, abandoned baby, graveyard doji, and stuff like that. And really, I find that it's pointless trying to memorize all these different patterns out there because they're just simply a variation of one another. And if you remember all the names and stuff like that, it's just going to, tire your mind out. So there's only two questions that you need to know when you're dealing with candlestick patterns. The first question to ask yourself is, where did the price close relative to the range? So if you look at these two patterns, right, the reason why they are bearish is because the price closed near the lows of the range. If you look at this candle, first one is the shooting star. This one closed, the entire range of this candle is from this high to this low. It's from this high to this low. So where did the price close relative to the range? So this is the range, right, from this high to this low. Well, it closes near the low of the range. If you look at it like in terms of percentage, right, let's say the high is at 100% and the low is at, let's say, 0%. This one pretty much closed, right, like I would say 10% mark of the range. So where do you close relative to the range? At the bottom 10% of this range. So this is, I would say, it's a bearish signal, right, because the price has closed near the lows of the range. Same for this bearish engulfing pattern. This is the highs. This is the lows. Where did the price close relative to the range? It closed near the lows of the range. So this is bearish. If you look at the bullish examples I had earlier, where did the price close relative to the range? Same concept. This is the highs. This is the lows. This price here closed near the highs, right, relative to the range. So really, the first question to really ask yourself is, where did the price close relative to the range? So because once you know whether it closed near the highs, the lows, or the middle, You know sort of what type of meaning to expect from the pattern. If you close near the highs, you know it's bullish. Near the lows, bearish. In the middle, it's indecision, so it's undecided. Okay, so that's the first question. Second question is this, is that where did the price, or rather where did the candle, what's the size of the candle relative to the earlier candles? So what I mean by this is that if you look at this, let's say the engulfing pattern, you see that the range of this candle, it's so much larger than the previous one over here. So this one is definitely more significant. There is more conviction behind it. Okay, because if you think about this bearish engulfing pattern, it could just as well look something like this. Let's say this is a green candle. It could also be like this. You see the size of this candle compared to this candle. Do you see the difference? So if you tell me in terms of conviction, in terms of like kind of like the strength behind the move, I would say this one is definitely more significant, right? Because the size of this candle is significantly larger than the previous candle. So when you look at candlestick patterns, you don't want to look at in isolation as well. You want to look at what's the size of that candle relative to the earlier candles, relative to the earlier 2 or 3 candles. Is it much larger or is it much smaller? Because if it's much smaller, then it's going to be less significant compared to if the candle is much larger compared to the earlier 2 or 3 candles. Make sense? So I'll share with you some examples later on, but these are kind of like 2 questions that I want you to bear in mind whenever you're dealing with candlestick patterns. So with that said, let's move on. Next one, right? So we have talked about market structure. We have spoke about area of value. We have spoke about entry trigger. So now, where do you exit if you're wrong? So this is a question, right? In essence, right? To ask yourself, where will I get out of the trade if I'm wrong? In other words, it's your stop loss. And the way to set your stop loss, right? You want to set it at a level where your trading setup gets invalidated. So first and foremost, let me share with you how not to set your stop loss, right? A mistake that many traders make. So let me just share with you how not to do it, right? So this is how not to. This is a bad example, so don't follow this. So let's say market is in a range. Okay, market's in a range. Up, down, down. And maybe near the lows of support, someone might think, oh, hey, Rayner, this price is at support. Area of value, time to buy. So they buy. So let's say just put here buy. Okay. And where do they set their stop loss? Oh, the textbook says, you should set your stop loss, below support, because that's where support breaks, set your stop loss there. So they will set their stop loss somewhere about here. Let's say here, stop loss here. Let's call it SL. Now, what's the problem with this? And the problem with this is, even if the price were to reach this level here, does it mean that support is broken? Well, not quite, because if you recall, support, right, serves to act as an area of value. That is an area on your chart. And if you were to put your stop loss just smack below support, what makes you think that support is broken? Because it could be an area, it could be a pretty wide area. So if you ask me, that area of support is still not invalidated. It's actually still intact. So don't set your stop loss, right, at a level where the setup is still intact. If you ask me, even if price were to head down to these lows, support is still intact. It isn't really broken to me because it's an area on your chart. So what you want to do is to set your stop loss at the level where if the price reaches it, right, it would tell you that, man, this support is likely to be broken. So if you ask me, it's probably going to be somewhere here. Because let's be honest, if the price were to come down to these lows at here, probably this looks more convincing that support is broken, right, compared to just below the lows of that level. Okay, so this is what we mean by, you want to set your stop loss at a level where it gets invalidated. Or let me give you another example. Let me talk about good examples, right, this time around. So let's say enough of bad examples. So let me just walk you through a few examples. So let's say you want to trade a double top. Okay, double top. Let's say double top, you wanna sell at a double top. Price goes up, comes down, goes up, comes down. So maybe it forms a double top over here. Okay, so where should you set your stop loss? Clearly, you've learned, right? You don't want to set your stop loss just smack above this highs or just above this highs, because that is an area of resistance. Ideally, your stop loss should go somewhere here. Because if you think about this, if the price comes down and it goes up and hit your stop loss here, let me ask you, does this double top still look intact? Doesn't look like a double top anymore, right? So this means that your setup is now invalidated. If your setup is invalidated, then you have no business staying in that trade anymore. Get out of the trade, cut your loss, move on. So that's how you want to set your stop loss, at a level where it invalidates your trading setup. Let me give you another example. How about a bull flag? Price hit higher, come down, bull flag like this. Okay, so let's say price then hits higher and trigger your bull flag trading setup. You go long. So where should you set your stop loss? Do you set it at A, B, or C? So B and C are the 2 primary answers I get, and I'm going to share with you why I lean more towards C. So yes, if the price comes back to B, right, your bull flag pattern will look quite weird. It becomes some kind of like, maybe like a double top or something like that. But why do I go with C? And it's very simple. The reason why I go with C is because, yes, price could hit B and the bull flag is invalidated. But if you look down shortly below here, this is actually a swing low. And a swing low, as you know, right, is where potential buying pressure could step in and push the price higher. So if you put it at B, you're actually cutting your loss into this swing low where the price could reverse higher and hit higher from there. So you don't want to do that. So what I'll do is I'll lean more towards C at a level where if the price really gets to C, right, I know that entire bull flag is invalidated. I know that swing low has broken down and I want to get out of the trade. Right? So there's no more bullish reasons for me to stay in the trade anymore. Okay, so that's my thought process for going with C. Okay, but I'm glad that you understand the concept that I've shared with you. Let's have a look at, how about some real world chart example. All right, sounds good. Let me share with you a trade that I hit a loss, right? Hit my stop loss, and let me explain how I set that stop loss. So if you look at this chart, Aussie Swiss franc. Okay, this is a losing trade, by the way, but I'm still glad to share with you. So what happened is that Aussie Swiss franc, when I took this trade, it was a, as you can see, uptrend, looking to buy from an area of value. So what happened is that I was actually referencing this area of support to set my stop loss. So I didn't want to set it smack below this low because, I could get, stopped out prematurely. So what I did is that I gave it some buffer from here to here, kind of like a buffer. But now the question is, hey, Rayner, how much buffer should I give? Should I give like 10 pips, 50 pips, 100 pips? So now this is subjective because it depends on the currency you're trading. It depends on the time frame. It depends on the volatility of the market. So one objective way to define the buffer is to use an indicator called the average true range. I'm going to walk you through step by step how this works. So what I did is that you go to your indicators, look for something called the average true range, pull it out, and I usually go with a 20 period HER and SMA. So what you want to do is that, you can do this for any time frame, like the daily time frame, weekly or whatsoever. This concept works the same. So what you want to do is find out what is the current ATR value of the time frame of the market you're trading. So in this case, it's about 30 pips, as you can see over here, 0.0030. So it's about 30 pips. So what I did is I then identify the low over here, and then I minus 30 pips. So I don't have my calculator here with me as of right now. So I'm just going to, just do some very simple round off mathematics. Okay, so let's say the low over here is 0.681. Okay, let's say it's this low over here, 0.681. I minus 30 pips. What that is going to give me, so minus 30 pips, that will give me a value of about, okay, if my math serves me right, it's going to be about 0.678. Okay, this value. So what I did is that at this 0.678 level, I'm guessing it's about here, this is my stop loss. And from here, this low down to my stop loss level is exactly 30 pips that we have, did earlier. Okay? So at this point, right, if you think that my stop loss is at this level, so let me ask you, if now the price were to reverse down lower and hit my stop loss, okay, does this area of support still looks like it's intact? Does the support behaves like how a support should behave? And I'm sure you can agree the answer is no, right? If the price hits my stop loss, right, it would look to me on the chart that this trade has gone wrong. Support didn't, held up, and I should get out of the trade, right? And let's see what happens. So we can see that eventually what happened on this chart is that the price went a little bit in my favor, a little bit, and it collapsed, and boom, right, hit me out for a loss at this area over here. I got stopped out. And what's interesting is that after I got stopped out, bam, broke out to new highs. And really, that is, again, the name of this business. Isn't trading so exciting? So yeah, I followed the plan, I followed the rules, I followed the concepts that I'm teaching you. I got stopped out of the trade, and then the market continued to break out and work in my favor. So yes, this happens from time to time. Don't think that just because you set a proper stop loss, this will never happen to you. That's not what I'm saying. But if you follow this method, this concept, right, more often than not, or there's a good chance that, your trade, right, will, or rather this concept, right, will help you avoid, right, getting stopped out of your trade too early or prematurely. Okay, so this is what we mean by, setting a proper stop loss. Moving on, right, next thing. We talk about exit if you're wrong. I believe you now know where to set a proper stop loss. Now, what about exit if you're right? What if the market moves in your favor? So now where should I, exit my trade? Okay, let's talk about this. So in essence, what this does is to tell you, right, where will you get out of your trade if you're right? And there are many approaches to this. I mean, this is a 2-hour session. I can't share every single approach to you, but what I would say, I would recommend, especially for new traders, since I saw earlier that many of you are like in stage 1, stage 2, is you can consider looking to capture a swing in the markets. So let me talk about why capture a swing. A few benefits is that your trading results are more consistent. Okay, your win rate will be improved. And the downside I can think of is that if you were to go with capturing a swing approach, is that you will miss out on trends because you're not able to ride trends because you exit your trade, earlier. So there's like kind of like a pros and cons to it. But from a psychological standpoint, I would say, having a higher winning rate to be more consistent in your trading is important, right, for new traders. So I'm going to share with you, right, a swing trading approach, right, where to exit your trade if you're right from a swing trading methodology. So let's get started. So we're going to capture a swing, and the way to capture a swing is you can use swing high, swing low, support, resistance as kind of like reference point markers on your chart, right, to help you capture a swing. So let's say market is in a range. Okay, let's say in the range, you buy near the lows of support. So to capture a swing, what you want to do is to ask yourself, where might opposing pressure come in? Because I want to get off the trade right before opposing pressure comes in. So if you buy at support, there's a good chance opposing pressure or sellers could come in at resistance. So this means that you want to exit your trade just before resistance. Why before resistance and not at resistance or above resistance? Remember, support resistance, it's an area on your chart. So if I were to kind of like properly define it, it's going to look something like this area. Okay, and support will be like this area over here. It looks kind of messy, but I think you get my point. So you want to exit your trade before this area of resistance, because what could happen if you set your, let's say your target above this highs or here, it comes into this area of resistance, face selling pressure, and then reverse down lower. And if your target is too aggressive, like at this highs over here, you will notice that the price almost reaching your target and then take a 180-degree reversal and then hit your stop loss. You don't want that. So what you want to do when it comes to target is to set it just before that area of resistance. Yes, you give up a few pips, you give up a few ticks, a few dollars in the stock markets, or FX is a few pips, but I would say it's worth giving up that few pips, right, than watching the entire trade turn sour and hit your stop loss. Okay, so you want to exit your trade, right, just before opposing pressure comes in. Okay, so let me walk you through an example. If you look at this one here, okay, let's say price had a bullish reversal here. At this point, price close higher, looks bullish, trading in an uptrend from this area of value, all looks pretty good so far. So where could we exit our trade, right, to capture a swing in the market? So again, remember, the key thing I shared is to exit your trade before opposing pressure steps in. And if you look at this chart, I would say opposing pressure could possibly step in, right, at this swing high. Like some people look at this as the, I'm not sure if it's the all-time high, but this swing high, right, where sellers could come in to, short the markets, or earlier buyers could look to take their profits at this level. So this is where you want to exit your trade, just before the swing high, which is about a $290 price point, just below it, maybe 288, 287. Okay, so this is how you don't go about capturing a swing in the market. So basically, you're going to capture this particular move here. Okay, so swing trading is in essence, right, capturing just one move in the market. You're not trying to ride the entire wave, the entire trend. You're just trying to capture one move, one swing. Okay. So now we have, covered quite a bit, right? We spoke about market structure, right? What to do in different market conditions, buy, sell, or stay out. We spoke about area of value, where to buy. We spoke about entry trigger, when to buy. We spoke about exit if you're wrong, stop loss. We spoke about exit if you're right, target. So at this point, right, we can actually use these new concepts and techniques that we have learned, right, to actually spot, trading opportunities in the market. So what I'm going to do right now is to actually share with you some trading examples, right, using the concepts that I've shared with you. And of course, you can use that to, trade the FX market, stock markets, whatever you deem fit. Again, verify, validate, and make it work for yourself. So own it, right? Own it. So let me just get started. First one I want to share with you is New Zealand yen. Okay, so let's get started. Okay, so for this trade here, you can see over here, we have a valid trading setup. Okay, we'll highlight the setup over here. So what happens again? Market structure, you can see that number one, market structure is hitting up higher. We are in an uptrend. Number two, area of value, we have this area of support over here. Number three, we don't really have exactly a bullish engulfing pattern, but I would say at this point, right, the buyers are in control as they have pretty much closed near the highs of the range. So, okay, bullish, let's call it, just put it up. Okay. Number four, stop loss, right? I reference this lows, right, and set my stop loss 180 below it. Okay. And number five, Where is the nearest target? Nearest target would actually, the nearest, or rather, the level where opposing pressure might come in would, I would say, it's just before this area of resistance, somewhere about here. Okay, so this is, I would say, a possible trading setup that you could have, traded. So I'm not going to walk you through the outcome of this trade because it's not important. I would say that the thought process, right, is really what matters. Okay, next one. Dollar against the Chinese yuan. So if you look at this one over here, pretty interesting. So this one, again, you can see that what is the overall trend of this market. Okay, number one, downtrend. Number two, area of value. So this one is quite interesting. We can see that the price retested previous support, which could become resistance and resistance. Okay, so we can just call it R. And number three, entry trigger. So this one is neither a shooting star or a bearish engulfing pattern. But remember, I said there are many variations to it. If you look at this pattern, right, this one seems to be that the market pretty much closed where it opened for the day. But during the day, it actually tried to attempt to break out higher, but failed to do so, and then close where it opened. So I would say this one is near the lows of the day. So I'll consider this a bearish signal. Okay, so that's bearish signal. Number four, area of, the exit if you're wrong, your stop loss. Again, I will reference this highs, set it 180 TR above it, somewhere about here. And then 5 potential target, I would say this will be the nearest swing low exits, will possibly before this level over here. And also one thing else to share with you is that there is a concept called stack levels, where you have multiple area of value coming together, or you can call it stacked area. So let me just share this with you. So you can see over here, if I overlay the 50 MA, it has the confluence of the 50 MA as well as this previous support, which could become resistance. So this makes this level even more significant. Okay, so this is the dollar against the Chinese yuan. Okay, moving on, another example. Okay, Aussie against the Swiss franc. I actually shared this one earlier. Okay, where the trade was a loss. So yeah, that's another example you saw earlier. And let's move, how about a little bit to the stock markets, because I want to share with you that, price action trading can be applied to stocks as well. So let's have a look right at the stock markets. So this one is Fiverr. Okay, I actually use this company for my own use, right? When in business, when I need people to help me, do some website, work. All right. So Fiverr, what it does is that it helps you connect freelancers with so-called business owners. So you can use freelancers to help you with whatever work you need, whether you need to transcribe a podcast, whether you need some graphic design, book design, proofreading and stuff like that. So yeah. So for Fiverr, let me just share with you this one here. So again, you can notice that when you look at the stock chart, one thing that very obvious compared to a forex market is that the number of gaps, right? You look at all these gaps, bump, gap here, gap there. So this is one of the key differences, and you have to be prepared for that. So again, right, if you look at Fiverr, the setup is over here. Let me just walk you through it. Number one, uptrend. Number two, area of value. So at this point, we are trading off this swing low over here. Okay, let's call it SL. It's not very nice. Let's call it swing low. Okay. Number three, entry trigger. So in this entry trigger, if you ask me, it's not a hammer, it's not a bullish engulfing pattern. I don't really have a fixed name for it. But again, using the two questions that we have learned, right? Where the price close relative to the range? Pretty near the highs. Second question, right? What's the size of the candle relative to the earlier ones? I would say it's pretty much on par. So, hey, since this one is on par, I would say the strength of these buyers, right, are pretty much matching the strength of the earlier sell-off. So, okay, fair enough. I would take this entry trigger as a bullish signal. Okay, but if you know, let's say in a downtrend or range market condition, I might choose to skip it because you can see, right, this is where discretion comes into play. But the reason why I could have afford to close one eye for this using my own trading approach is because I'm trading overall in the direction of the trend. The trend is strong. And if you overlay the 50 MA, which I'll do so later, it also has the confluence of the 50 period moving average. So weighing all these multiple factors together, this is a trade that I want to take. Okay. And number four, stop loss, right? Again, I can reference this swing low to set my stop loss possibly somewhere here. And number five, target, right, to capture a swing, exiting just before this swing high over here. Make sense? So again, I'm just going to, share maybe the 50 MA if you want to see. We have the confluence of the 50 MA. There you go, over here. All right. So yeah, that's pretty much it. So one last example, shall we? One last example. Kirkland. So again, same concept. If you look at this market, overall trend is towards the upside. Okay, overall trend is towards the upside. Area of value, this one now is also like a kind of like minor swing low, right? Let's call it swing L. Entry trigger. So if you look at this entry trigger, now notice it's bullish, yeah, but if you look at the size of this candle relative to the earlier ones, it's actually quite small. Okay, so this is again where your discretion comes into play. You might think, man, Rayner, that candle looks really small, not very convincing. I don't feel comfortable taking the trade. Then hey, then don't take, right? This is a discretionary trading approach. No one's pointing a gun at your head and saying, you better take the damn trade or else you're beep, 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 boop, right? So no one's pointing a gun at you. So if you feel that, sorry about that, I had a dry cough here. So if you feel that, you're not comfortable taking the trade, the entry trigger, it's not convincing, skip the trade, move on. There are like hundreds of other trading opportunities out there. You don't have to force things. Okay. And again, stop loss would just go 1 ATR below this low, somewhere here, and target just before this swing high here. So hopefully these few examples kind of give you the concepts, right? The techniques, the strategies, right, that we are looking at as a price action trader. And of course, there is much more, but hopefully this, gives you a good foundation, a good framework to start with. Let's talk about the trading setup. Rather the setup that I'm looking at. First one, right? Let's look at ENPH. This one here. So this one should be quite straightforward. You can see that overall this market has been in a nice bullish uptrend. That's number one. Okay. Area of value, you can see they come into this area of support. Quite straightforward. Let's call it S. Number three, we have this nice bullish entry trigger, right? You notice how this candle closed near the highs of the day. I would say it's close towards hammer. You won't really exactly call it a hammer because hammer, the wick is much longer. But again, I don't want you to get confused and focus so much on the exact theory terminology that you miss the forest for the tree. Just know that, hey, this is a bullish signal, right? And the range of this candle relative to the earlier ones, right, it's not too bad as well. It's pretty large. Okay, so that's our entry trigger. 4, right, stop loss, right? I'm going to reference this lows to set my stop loss, probably going to be somewhere here. And number 5, target will be just before this swing high if you're looking to capture a swing in the market. So this is for ENPH. Next trading setup, right? How about another one, CELH? So this one you can see over here. Concept is the same, so I'm going to move quickly, right? Because really, I think I've hammered home this pretty much long enough. Overall uptrend is up at this area of value, this swing low. We have a bullish price rejection. So you look at this, right? This candle actually closed red. But when you deal with candlestick patterns, you can't just look at the color of the candle and say whether it's bullish or bearish. Yes, this one is red. But look at it, in terms of the context. Where did the price close relative to the range? It actually closed near the highs of the range. So yes, it closed lower. It closed below the opening price. But if you look at it relative to the entire range of the day of the candle, it actually closed near the highs of the range. So I would actually say this is actually a bullish, candlestick pattern. All right. So notice how price reject this lower prices and close near the opening price of the day. Is below it, but still bullish to me. So you can look to enter on next day open. Stop loss can go 1 ATR below this lows. Possible target again just before this resistance or swing high. And also one thing to point out is that sometimes when you trade, you can be like a kind of like a cheapskate and get a better entry price. So sometimes you might think that, oh man, the price has, maybe like, let's say for example, I think this one, let's say EMPH, right? Let's say it closed so near the highs of the day, right? I don't want to be buying at such high price. What you can do is set a limit order, a buy limit order, and maybe let's say put it somewhere here and get filled, right? If the market does a retracement, you can get filled at a better price. So what this means is that your stop loss will be tighter. And if your stop loss is tighter, from a risk to reward standpoint, you're going to find yourself, entering more favorable risk to reward trade. So let's say your stop loss is now, let's say $1. Okay, so this means if the market moves $3 in your favor, that's a 1 to 3 risk reward on the trade, right? But if let's say your stop loss was initially $2, if the market moved $3 in your favor, that's only a 1 to 1.5 risk to reward on your trade. So you can see that the size of your stop loss matter. If you can get a tighter stop loss, right, you are going to improve the risk to reward on the trade. Okay, and just one last final example that I have for you. So if you look at Forex, this is the daily time frame, right? If you look at 8-hour time frame, similar concept over here, right? Market overall is in an uptrend, higher highs and higher lows. And this is the swing low that you want to pay attention to. Okay, it's an area of value. And then what we can look for is a potential bullish price rejection to be a hammer, an engulfing pattern, price come down low and close bullishly back above the swing low. So what the key thing that we're looking for is for the price to get rejected quickly from that swing low, right? The faster the price rejection, the better. Then we can look to enter on the next day open. Stop loss 1 ATR below this lows. First possible target just before the swing high. Does it make sense? So you can see that, this is really the concepts that are, I'm sharing. So let's do a quick recap to what you've learned today. Number one, market structure. This tells you what exactly to do, right, in different market conditions. If the market is trending higher, we look for buying opportunities. If the market is trending lower, we look for selling opportunities. Next, area of value. So where do we look to enter our trades? We can look to enter from an area of value like support, resistance, trend line, moving average, etc. Then we look for an entry trigger to get us into a trade. This could be things like, reversal candlestick patterns, shooting star, hammer. And also, the next thing is to exit when you're wrong. So this is otherwise known as your stop loss, right? Where will you set your stop loss, right? Where if the market moves against you. And finally, exit if you're right. What if the market moves in your favor? So where will you take profit? So now, if you have enjoyed this training so far and you want to dive deeper into price action trading, then this is what I recommend, right? Get a copy of Price Action Trading Secrets. This is a 140-page physical color trading book, and you can get it at priceactiontradingsecrets.com. I'll put the link below. And in this book, right, we will dive deep into price action trading. For example, I'll share with you how to draw support and resistance correctly, how to tell when support resistance will break. We'll dive deep into candlestick patterns, chart patterns, how to trade breakouts, how to trade reversal, risk management, and much more. So when you get a copy of Price Action Trading Secrets today, I will also, right, add in 3 additional bonuses for you. Bonus number 1 is a PDF version of Price Action Trading Secrets. So instead of waiting for the book to ship to you, which will take about 4 weeks, you will get an instant digital copy of this book so you can read it and get started immediately. Bonus number 2, I'll give you a position sizing calculator, right, so you can manage your risk and never blow up another trading account. And bonus number 3 is for you, is part-time trading secrets. This is for you if you're a part-time trader and you want to learn, right, how to actually hold a full-time jobs and still trade the markets part-time, right, in a consistent and profitable manner. So if any of this if you're interested, right, to get a copy of Price Action Trading Secrets, just go to the link priceactiontradingsecrets.com, click any of this blue button, right, and you can get access to this book. And by the way, it has a 60 days money back guarantee. If you read the book, you find it's not for you, I'll gladly issue you a full refund, no questions asked, and you can still keep the book. So this book, right, is $18.90 for international customer, meaning customers outside of the US. If you're in the US, it's only $12.90. So just fill up this form and you can get started immediately. So with that said, I wish you good luck, good trading. I will talk to you soon.